If I begin with you, I guess the risk always was even higher, even faster, and for even longer. That's kind of what he said today, is the possibility.
Yeah, and that we're also going to be data dependent, right? And so we have a lot of data. We talked about this last week. We have a lot of data that's coming this week with jobs, CPI, PPI, retail sales next week. That's going to be very important. But honestly, Scott, I don't think a lot of what he said was that surprising. We've been talking about the economy doing better, right? Led by the consumer, and he cited consumer spending. We know jobs have been white hot. They continue to be white hot, which this is why the Friday number is going to be super important. He also talked about manufacturing improving in January, which is a bit of a surprise, right? Because that has been some part of the economy that hasn't been that great. And then he talked about inflation, and we've been talking about inflation whatever way you want to measure it. CPI, PPI, core PCE, unit labor costs. He mentioned services ex housing several times. We know the last reading was a 7.7% rise. So we know that that part of the economy is the problem, and it's going to be harder for them to change that, to be honest. So But I step back and I say, wow, wait, the economy is not terrible, which is what we've been talking about. Pockets not so good. But then I listen to someone like the Eaton CEO on the show earlier today, and he's talking about 85% of his end markets, they expect to see solid double-digit growth in 2023. And that's all because, obviously, infrastructure and the reshoring. And so there are kinds of pockets within the economy that are okay. And those are the areas where I still want to be invested in from a portfolio management point of view.
You know, Steve, I guess you had to figure that the chair was going to be more hawkish today. That was the risk, I guess, going in. It's notable, too, that what Phil LeBeau reported earlier about used car prices and the Fed chair discussing the fact that goods disinflation seems to be slowing a bit and services disinflation is really slow. And therein lies the problem, right?
Yeah, he's just not getting the help. I think it was interesting the way he kind of explained how his view has changed because of the data that we've been talking about almost every day from January. Not only did it come in hotter than expected, but it was those revisions. And Governor Waller gave us a bit of a curtain raiser on how that's affected Fed officials, basically saying, you know, the data's changed, so the outlook has changed. And that's why you get this idea that if the data remains the way it has been, when the Fed goes to pencil in a new terminal rate in March, it's going to be higher than they previously put in there. And I don't think the market was quite prepared for that. I think they were prepared for the idea that it could be higher. But what it wasn't prepared for is the idea of a more rapid pace, the idea they go back to 50s. And Scott, I just want to go through. It's a little complicated, guys, but if you could put up the probability changes that we've seen, what's happened now is you have, and I'm going to put my glasses on and look at this, Scott, 56% probability they go up to 5.25, and that's more than double the percentage it was before the speech. And then a 93% probability you go to 5.25, 5.5, 71% probability you go to 5.5, 5.75. You can see all of those percentages are substantially higher. So what the market has now baked in here, Scott, is, as you said at the top of this segment here, higher, longer, and perhaps more rapid. He just said again that if the data continues to come in the way it's been, we could get there more rapidly.
Because, Jim Lebenthal, you got a couple of problems. You got the economy is hotter than the Fed chair wants it, and disinflation is slower than he needs it, which is why we just had this conversation with Steve, and the chair said what he did today. That's not a great message if you're touting all of the bullish things you see in the stock market for reasons why equities can continue to advance even in the face of everything the Fed's doing.
Scott, that's an excellent assessment that you just said. My qualification to it, I hope you'll allow this, is that we were in a different context, a different sentiment about 5 weeks ago after the last Fed meeting, right? Remember, that's when he started talking about disinflation, and disinflation started to hop up in the media hits. It was 2 days later you got that labor report for January, and then you had 4 weeks of January data that was just not good. It was not good, and it really did blow a hole in the disinflation theory. The problem is, I don't know, and you don't know, and nobody knows if January is an aberrational blip. Let's remember that 3 months prior to that, October, November, December, you had good inflation, better than expected inflation.
Not
numbers.
necessarily from the services side. That's the part that you haven't.
Let me come right back
gotten
to that.
To well, it's the most important point.
Okay, but let me.
That hasn't cooperated with you.
Let me get right there. Okay, but let me just say we don't know if January's numbers, which is all that the Fed has in front of it right now. When he speaks right now, Powell is focused on January's numbers. We don't know if it's an aberration or a blip. We need February's numbers, which starts this week with average hourly earnings.
Jim.
Then you get CPI, PPI. Steve, give me 1 second because I want to address Scott's point. It's a very good one. Okay, I understand we are looking at this granularly. The Fed is looking at this granularly. Services, ex-shelter, core ex-shelter. I get it, but you have to understand, as much as he doesn't want to admit it, the Fed is a political beast. And if you get headline CPI, which is what I'm talking about, if you get it moderating, that's a big if, okay? But if you get it moderating, the Fed is hell-bent for leather to crush jobs, while CPI headline is moderating, that's going to be a political problem for them.
Steve?